Hi, I'm Christine Kopr with Sotheby's Realty in Vancouver, BC. We're going to take a look at September's numbers now that they're in. And boy, oh boy, there are some shifts coming. However, not every market segment is affected by today's market circumstances, as you may think. So, market drivers right now, what's driving the market? It's always four things. It's consumer confidence. What's the psychology in the marketplace? And are people wanting to spend their money? So a couple things with consumer confidence, we're going to take a look at that in terms of sales. People are still spending money in terms of retail sales. However, we are starting to get more and more negative media out there about interest rates and the economy. There's a lot of market participants who are suggesting that we are on the cusp of a recession. So that starts to impact the way that the buyers feel. We are seeing less multiple offers, and we're starting to see, less sales. So we'll see what happens with that. But there is this shift. Again, we've had 2 months of the MLS benchmark taking off a little bit, which encompasses not just Metro Vancouver, Vancouver West and East, but goes all the way out, like I said, from Whistler to Maple Ridge. And we're starting to see a little bit of a trend, and be interesting to see where that goes this fall. My guess is we're probably going to see some downward pressure on prices, and especially because of inflation and the economic situation. Jobs numbers came out stronger than expected yesterday. Inflation is still high, although the economy is showing signs of slowing. So the reason why this is important is because it's very impactful on the Bank of Canada and what they're going to do with interest rates. And speaking of interest rates, it's probably the number one thing impacting the market at this point in time. We had a hold on any rate increases from the Bank of Canada earlier in September. The next announcement is October 25th, and they're going to take a look at all of the market drivers and information out there to make a decision as to which way to go. We did have strong job numbers just yesterday on the cusp of their meeting, and we'll take a look at some of the other information out there with respect to inflation, etc., in the coming slides. So there's a strong chance that we could see another interest rate increase. And of course, that is really starting to make things painful out there in the marketplace. You're starting to see people having to qualify at 8% or plus, even though their rates are slightly lower. And that is drastically different than earlier this year in the spring, particularly because the bond market has also gone a little bit wild. And the Bank of Canada determines your variable interest rate mortgage rates or your line of credit rate, anything that fluctuates. But if you're somebody who wants to purchase a 3-year or a 5-year fixed term mortgage, the bond market influences that. And the bond market has been going a little bit wild over the last several weeks, really pushing those fixed rates, whereas they were sitting at about the high 4s earlier in the spring. So substantially different between now and the spring. The saving grace so far has been that we've had very low inventory in the spring and very low inventory overall, and in comparison to the demand in the marketplace. So we're also going to have to keep a tight eye on inventory and see if more housing comes into the marketplace. Here you can just see some of the information with respect to these drivers. They are the things that are going to impact our rates because they influence the Bank of Canada and the bond market. So you can see here retail sales are stronger than they were prior to COVID. People are still spending money. Inflation, you can see here, these are all the different measures of inflation. They're all higher than this dashed line, which is the 2% target. And as long as they stay in this territory, that actually does incentivize the Bank of Canada to increase mortgage rates, because it is the only tool that they have to try to slow down the economy. And if you're wondering what that means, it means that people stop spending money. And people stop spending money generally when they can't afford things like their mortgage payments or they lose their jobs. And that's the part that is the scariest, is if the Bank of Canada pushes interest rates to a point where businesses aren't active because people aren't spending money, and then people start losing their jobs. That's the thing that we really don't want to see, because while we do want to tame inflation because it hurts everybody, recessions also hurt people when they lose their jobs. And none of that is really fun. So while we really want to see inflation come down, the Bank of Canada is trying to make this happen as best as they can without that occurring. and we shall see. We're very hopeful that they hold steady with their interest rate increases. However, it's probably wise to expect at least one, maybe two more rate increases. And then hopefully they'll be high enough that they're going to do the job and really slow the economy down. The shining light, however, is that while it takes time for these rate increases to make their way through the market, the economy is showing signs of slowing. So hopefully the Bank of Canada just keeps rates where they are and they just allow them to work through the market over time to hopefully slowly have this broad change to the marketplace and not send the economy into a recession. And here you can see where our interest rates are sitting today. This is the bond market here. As you can see, it did spike. And here's a rate forecast, something to actually really consider if your mortgage is coming up for renewal in the next year or year and a half, to really start planning and thinking about what you may want to do. Because I think there was a lot of people who thought this spring that we would start to see decreasing interest rates early next year. And based on the way things are going, that is not looking likely at all at this time. It looks like rates need to stay higher for longer. They may not need to go higher from where they are today, but they very well might need to really slow things down and stop the inflation and get it under control. And even then, if they go up, they'll probably need to stay there. They're not going to just trend down the next month. So for anybody with a mortgage that's renewing in the near-term future, you may want to start thinking about a plan for when that time comes, because my guess is while hopefully in a year or two, we're not going to be sitting at the rates we are today, but it's very likely that we could be sitting in the ranges, in the fives, very possibly. And that can be a big shock for anybody who coming from a rate of say 1.8 or 1.09 in some cases, for those that got mortgages back in 2020 with the 5-year coming up in 2025. Despite all of that, the real estate market has surprised us like it did this spring. I'm Christine Kopr with Sotheby's Realty in Vancouver, BC. If you have any questions about your own personal situation, I would love to hear from you, and I welcome you to connect with me. Please like and subscribe to my YouTube channel and my Instagram if you like information like this, and I look forward to hearing from you.